Good afternoon, and thank you all for coming. Thanks to Fred for those very kind introductory remarks. When I was writing my notes for this talk, a colleague came up to me and asked, how can you prepare a talk on this subject with all that's gone on in the past few weeks, changing day by day? And his question about preparation reminded me of the two fellows who go out to dinner. One of them orders roast chicken and finds it's the best roast chicken he's ever eaten in his life. In fact, he's so excited about it that he says, I've got to go back into the kitchen and compliment the chef. So he goes back into the kitchen, tells the chef how much he enjoyed it, and says to the chef, I got to ask you, how do you prepare your chickens? And the chef says, well, I level with them. I tell them, you're not going to make it. Well, today, I'm going to level with you. But unlike the chickens, I think you will make it through this crisis. In my presentation, I want to do three things. First, I want to review quickly a number of key highlights in the crisis, mood music, if you will. Second, and this is my main purpose, I want to share with you my 10-plank program for financial regulatory reform. This is an expanded and updated version of the outline that I gave more briefly last April. And third, I want to comment briefly on the crisis management strategy over the next few months, including the design and implementation of the Troubled Asset Relief Program, the TARP, that was agreed by Congress on October 3rd, or as some people refer to it, the Leave No Banker Behind program. Because there is a lot of ground to cover, I plan to speak fast. Not to worry, you should have in your packets a copy of my speaking notes, which lays out everything perhaps in excruciating detail. So aside from some numbers, you have what I have. If you doubted it before, events of the past few weeks should have convinced you that the United States is in the midst of a truly world-class financial crisis. Let me just remind you quickly of some key developments. Credit losses at financial institutions. In July of 2007, Fed Chairman Bernanke estimated that credit losses associated with subprime mortgages would probably wind up in the $50 to $100 billion range. A September 2008 report from S&P estimates that credit losses on subprime mortgages will be about $380 billion. A September 2008 report from Goldman Sachs estimates that credit losses from all mortgages will be about $640 billion. Going wider still, if you add in commercial real estate, credit card, auto, and student loans, corporate loans, bond defaults, and you include losses by hedge funds, insurance and finance companies, mutual and pension funds, then we could get projected credit losses in the range of, let's say, $750 billion to $2 trillion. The April 2008 IMF Global Financial Stability Report put estimated credit losses at nearly $950 billion, but that has grown, I'm told, to $1.3 trillion in the latest version of the report, I think, released today. Total write-downs and capital raised by financial institutions. Total write-down by financial institutions worldwide since the outset of the crisis now are about $500 billion, whereas capital raised by financial institutions is just short of $380 billion, including about $65 billion from sovereign wealth funds. Credit and liquidity spreads. We've seen both high volatility and exceptionally high levels of liquidity and credit spreads. This is true whether you look at the money market spreads, spreads on agency bonds, credit default swaps, yields on corporates, and no matter whether you look in the U.S. market, the Eurozone, or the UK. For example, the TED spread, which averaged about 45 basis points over the 2001 to 2008 period, and about 100 basis points since the beginning of 2007, hit 350 basis points on September 30th. Similarly, LIBOR hit almost 7%. At one point during the past 2 weeks, the LIBOR OIS spread is at a historic high. Meanwhile, bank credit growth has gone negative, the commercial paper market has frozen up, and the issuance of securitized assets has plummeted. Flight to quality. We've seen a massive flight to quality with yields on 3-month U.S. Treasuries going lower at one point than at any time during the past 50 years. The yield on a 4-week Treasury hit 0.14% on September 24th in the face of a consensus inflation forecast for 2009 of almost 3%. U.S. equity prices. The S&P 500 index of U.S. equities is down 28% this year and 33% from the peak. Bank failures and deposit insurance. Several weeks ago, we had, with Washington Mutual, the largest bank failure in U.S. history, although fortunately it was resolved without any cost, either to the taxpayer or the FDIC insurance fund. There have been less than 15 bank failures this year, but the FDIC problem list includes over 100 banks, and some private sector analysts expect that figure to go considerably higher. The coverage and limits of bank deposit insurance are being increased almost everywhere, including in the U.S., from 100 to 250,000. Liquidity injections by central banks. Central banks in the U.S., the Eurozone, the U.K., Switzerland, and elsewhere have engaged in unprecedented injections of liquidity to deal with shortages and maldistribution of liquidity. In the U.S., the Fed has progressively increased the scale and duration of its assistance, has expanded the range of collateral it will accept, and has broadened the range of eligible counterparties. We now have Fed liquidity assistance going to primary dealers, investment banks, insurance companies, and just this morning, non-financial companies issuing commercial paper. This is not your father's lender of last resort. Some people say that if the only tool you have is a hammer, you see everything as a nail. Public sector bailouts and guarantees. When I talked about the credit crisis in April, relatively little public money had been expended. We had the $150 billion fiscal stimulus package. Bear Stearns. Well, things have changed a lot since then. We have Fannie and Freddie, perhaps $200 billion, certainly more than the $25 billion estimate CBO. We have the $85 billion loan to AIG. We have the $50 billion withdrawn from the Exchange Stabilization Fund, and we have the $700 billion Emergency Economic Stabilization Act and the TARP. Changes in the structure of the U.S. financial industry. There are no more large independent U.S. investment banks. Lehman's in bankruptcy, Merrill and Bear have been acquired, and Morgan Stanley and Goldman have opted to become banks. Someone told me the other day that the largest independent U.S. investment bank is now Raymond James. It looks like a funding model that depends heavily on short-term collateralized borrowing and on prime brokerage deposits from hedge funds is like the chickens, not going to make it. Fannie and Freddie's hybrid public-private model also seems to have had it. Their public will become private, not both at the same time. There have been temporary bans on naked short selling and short selling for financial stocks. Exchange rates. The real effective exchange rate of the dollar is down about 5% since the crisis began. In a way, this is a ray of sunshine. If there had been a disorderly decline of the dollar, there certainly would have been less room for maneuver in U.S. monetary policy. House prices and home foreclosures. While different measures give different answers, the Case-Shiller 20-City Index shows a cumulative decline of 20% since its peak and a 16% decline over the past year. If house prices fall by another 10%, it is estimated that 1 in every 3 U.S. homeowners will have negative equity. Foreclosures are estimated to hit about 3 million units this year, way up from the average of the previous 5 years. Links between the financial sector and the real economy. Some analysts have attempted to link the difficulties in the U.S. financial sector, falls in bank assets, bank capital, and bank lending, to slowdowns in U.S. economic growth. A recent study by Hatzius concludes that a $630 billion aggregate credit loss by U.S. financial institutions would be associated with a 1.8% fall from baseline in U.S. real GDP each year in 2008 2009. If the GSEs, that's if the GSEs continue to expand their mortgage books. If they do not, then he finds it would be 3.2% per year from baseline. Others are less pessimistic. My colleague Mike Musa noted in his Global Economic Prospects presentation on September 26 that among the 49 professional forecasters reported in the blue chip economic indices, only one projected growth for this year in the U.S. of less than 1.5%. Bob Samuelson has reminded us that in the 10 recessions experienced by the U.S. in the post-war period, there was an average real GDP decline of 1.8% and a peak monthly unemployment rate of 7.6%. We are not at those averages yet, but I suspect that we will wind up in the end with a crisis surpassing those averages. I take it also that some people no doubt have adjusted their forecasts in the last 2 weeks. Contagion to other crises. When I spoke last April, contagion to emerging markets was quite minimal. Not so anymore. The equity index for emerging economies declined 11% yesterday and is now down 31% from its pre-crisis level. While the MB Plus bond index is running at about 500 basis points above U.S. Treasuries, much less than in some earlier financial crises, but way above its pre-crisis level. And the crisis is now very visible in Europe, especially in the banking system. A not surprising development given that European banks bought almost as many mortgage-backed securities, U.S. ones, as U.S. banks. Expected duration of the crisis. Some say this crisis started in February 2007. Some say June or July of last year. But the more intriguing question is, when will it end? The honest answers to that question are, we don't know, and it all depends. But if you want something a little more specific, there are 3 guideposts you can look to. One is the behavior of economic growth rates after earlier systemic banking crises in a sample of industrial countries and large emerging economies. Work by Reinhardt and Rogoff, among others, suggests that economic growth remains below potential for 2 to 3 years after the onset of a banking crisis. So if the crisis started, say, in the middle of 2007, U.S. economic growth would remain below potential until, say, the middle or end of 2009. A second approach is to compare write-downs with estimates of total credit losses. As indicated earlier, if total worldwide write-downs are, say, $500 billion, and you think in the end the losses will be $1 to $1.5 trillion, and if you write them off at roughly the same rate as you've done before, well, then you're halfway there, or maybe even a little less. Yet a third approach is to see the crisis ending when U.S. housing prices reach their equilibrium level or stop falling. If you look at normal ratios of house prices to rents or house prices to per capita disposable income, you conclude that U.S. house prices bottom out sometime between the middle of 2009 and the middle of 2010. Policy could, of course, move dramatically to try and alter the duration of the crises. Okay, that's the mood music. That's where we are. Let's talk about what we could do to change financial regulation to lower the odds of a recurrence of this type of severe crisis. We've already had a large number of reports from the official sector and from industry groups, including the Financial Stability Forum, senior bank supervisors, the President's Working Group on Financial Markets, the IMF, the IIF, etc. Well, let me give you a summary of my 10-plank program. Reform number 1, a prompt corrective action and orderly closure rule for systemically important non-banks. We need an analog to what we have for banks under FDICIA and SEBA. Under the current situation, if you have the impending failure of a systemically important non-bank, the authorities have 2 unappealing options. 1, put it into Chapter 11 bankruptcy and accept creditor stays and potential market lockups not helpful to restoring stability. Option 2, make a quick decision over the weekend to implement a large bailout on terms not necessarily most favorable to U.S. taxpayers. The bank resolution framework under Fiducia and SEBA works much better. You have capital-based triggers for corrective action. You close the bank when it still has positive net worth. You wipe out existing shareholders and change management. You resolve the bank at least cost to the FDIC insurance fund. The receiver can establish a bridge bank that keeps the bank operating under FDIC-appointed management and ownership. What you want is a framework that combines continuity of operations, good moral hazard properties, gives some discretion to the crisis manager for payment priorities, and provides crisis managers with more time to think. Of course, you need some funds to pay creditors before assets are sold. This could be done with an ex-ante levy on systemically important non-banks. You would probably have to define systemically important by reference to a combination of size, interconnectedness in financial markets, and leverage. This framework for non-banks would have been useful, I think, in the cases of Bear Stearns, Lehman, Merrill, and AIG. I've been pushing this idea since April. Others in the official sector have come out in support of something like this, including Secretary Paulson, SEC Chairman Cox, FDIC Chair Blair, but we still don't have it unless you interpret the TARP as being able to be used for this purpose, which I think is not clear. Okay, second proposal. We should have an international quantitative liquidity requirement for banks, along with private sector pooling arrangements for liquidity. Over the past 50 years or so, if you look at banks in G7 countries, what you notice is they have economized a lot on the shares of cash and liquid assets in their total assets. This longer-term trend away from owned liquidity toward just-in-time borrowed liquidity was exacerbated in the run-up to the crisis. In the worst of the crisis, even collateralized borrowing against investment-grade collateral may not be available. SEC liquidity guidelines were designed so investment banks could withstand the 12-month interruption of unsecured financing, but it was assumed that secured financing would always be available. The Bear Stearns case and others shows this assumption is no longer tenable. Banks may also hoard liquidity in a crisis, either because they're uncertain of their own liquidity needs or they're nervous about the creditworthiness of their counterparties. Central banks can compensate for all this by offering large-scale liquidity assistance to a broad range of market participants. But the larger, more frequent, and longer-lasting is such assistance, the greater the risk that the official lifeline will undermine incentives for market participants to insure against liquidity risk. So what you need is a clearer picture of what is minimum regulatory liquidity, along with greater incentives for holding it and sharing it with others. That's why I offered the liquidity proposal last May, which also should be in your packets. It was an op-ed in the FT. And the basic idea is you would define regulatory liquidity narrowly. It would give a dominant role to cash and treasuries, which we know will be liquid in the crisis. You penalize short-term borrowing rather to longer term. And you set a minimum quantitative benchmark for it like you do for capital. Imagine where we'd be on bank capital if we just had principles and no quantitative number. Part two, you create these private sector liquidity pools where each member deposits with the pool an agreed quota of treasuries, which you can draw instantaneously when needed and without challenge, and you can overdraft. Also, all pool members agree as a condition of membership that they will lend to other members, and market and default risks are shared among members of the pool. Part three, when liquidity needs go beyond the capabilities of the pool, you go to your national central bank as the lender of last resort. But access to the central bank carries a higher interest rate, and it's assumed that you normally go there only after you've used up the pool. When my proposal was put forward in May, suffice to say that many were skeptical. Many still are skeptical. But note that on September 15th, this year, 11 major banks set up just such an emergency liquidity pool with $77 billion in resources. And then I think it's similar to what I was suggesting. I think we'll need more of them. Reform number three, the Basel II bank capital regime should be reworked, not just tweaked, in favor of higher minimum capital ratios, making the regime countercyclical, adding a leverage ratio alongside the risk-weighted capital measure, and dropping the use of credit ratings and internal models to calculate risk weights. The existing minimum risk-weighted capital ratio is too low. It's 8%. Financial institutions have had to raise $400 billion worldwide in capital, and if you believe the estimates of future credit losses, they're going to have to write down a lot more. It's becoming harder to raise it from private sources, and governments are now having to get into the game. Even though banks went into the crisis with ratios considerably above the minimum, bank capital has proved inadequate to deal with the bad credit decisions. If banks had higher capital cushions, there would be no need for the potentially costly public interventions like the TARP. Hence, after the crisis subsides, we should be recommending a significant increase in the minimum capital ratio, say from 8 to 12 to 14%. You ought to want to make that regime counter-cyclical, not pro-cyclical. What you want is when you're in the upswing of the cycle, you have to have a higher capital requirement, so you cut back on lending, and when you're at going to the bottom, you want it to be lowered. The best way to do that is to make bank capital a function not just of the level of assets, but of the change in assets. And there's a proposal like that from Persaud and Charles Goodhart. In the U.S., we require banks to meet not only a minimum ratio of bank capital risk-weighted assets, but we also have a simple leverage ratio. Most other countries just use the risk-weighted measure. We should push for making the leverage ratio also a part of the regime. It provides protection against mistakes in the weighting scheme. It prevents some less desirable forms of regulatory arbitrage. And most important, it acts as a binding constraint on the buildup of leverage on the way up in the cycle when funding conditions are ample. It's a big debate on this going on in Switzerland, with the Swiss National Bank wanting the introduction of the leverage ratio and the Swiss banks opposing it. The Swiss National Bank is right. The banks are wrong. One of the main innovations of Basel II was to provide more sophisticated differentiation among risk categories by allowing banks to use their internal models and by using credit ratings as risk weights. But the credibility of those innovations has been seriously damaged by the crisis. The performance of credit ratings has been dismal, and so too with the performance of banks' internal models. What we should do is temporarily suspend use of credit ratings and internal models in favor of weights chosen by bank supervisors until we get evidence of better performance. The Basel Committee and others are reluctant to do that because it was such a long and arduous process to get Basel II in. But if two of the main features don't work, what's the point of keeping it and not changing it? Reform number 4, we need better coordination between the monetary and regulatory authorities during the buildup of asset price bubbles. Both of them can't say simultaneously that the identification and pricking of asset price bubbles is not my job. Central banks have argued for some time that they should not attempt to prick bubbles because they have only one instrument, short-term interest rates, and they need that for price stability. They say they can't identify asset price bubbles. Interest rates are too blunt an instrument to deal with them. And in any case, when the bubbles bust, you can just lower interest rates and take care of it. Others, including the BIS, have said no. If you look at the notable crises of the past 75 years, they're not preceded by a significant run-up in inflation, and there are good early warning indicators. More recently, a view has been, well, you should prick some of them, which are the ones that are associated with credit booms, but monetary policy shouldn't be the instrument. You should do it with regulatory policy. Some others disagree, including former Fed Chairman Greenspan. He has maintained that bank loan officers are more knowledgeable about credit risk than regulators, and that regulators confronting real-time uncertainty have rarely, if ever, been able to achieve clarity so that they can move preemptively. His conclusion is, well, neither one of them should do it. And it's not without significance because the Fed is the senior supervisor for bank holding companies. I don't buy the Greenspan doctrine, even if one were to accept the notion that central banks shouldn't do it. I think supervisors then have to step in. They're not subject to the same competitive pressures as bank loan officers. They should also be able to identify unsustainable concentration risk. Fifth reform, clearinghouses should be established in the OTC derivative markets. If that takes too long, incentives should be considered to shift more of trading to the organized exchanges. According to the BIS figures, there's approximately $600 trillion, yes, trillion, not billion, of OTC derivative contracts outstanding. On the exchanges, you have about 80. Credit default swaps are in the 50s. The problem with so much of the trading taking place on the OTC market is that you don't have the same level of systemic protections you have on an exchange. On an exchange, you have a well-capitalized central clearing party that acts as a counterparty on all trades. They enforce initial and maintenance margins. Your net position is known in real time and is recorded electronically. And price information is transmitted to everybody. The systemic consequences of a failure by one trader are likely to be much more limited. Yes, on electronic trading, you have the fat finger problem if you hit the wrong key. But outside of that, you can put protections into your software at the cost of being a little slower. All that said, the OTC markets could not have grown as large as they have without some advantages, and one of them is clearly customization. The question is, how much is that worth, given the systemic risk? The perils of AIG also illustrate what can happen when the financial unit of a large conglomerate builds up hundreds of billion dollars of exposure in the CDS market and then in the end doesn't have fast enough access to the firm's capital resources to meet escalating collateral calls. The Fed of New York has been pushing harder to improve infrastructure in these markets and has been making progress. I think there's a meeting today on establishing a clearinghouse in the CDS market by the end of the year, but that market only accounts for 15% of the outstanding contracts. We've been lucky that we haven't had more and more costly accidents in the OTC market. We need to get there fast with central clearing parties. And if we meet resistance on that, I would say we ought to move toward putting a higher capital charge on trades conducted in the OTC market, or altering bankruptcy procedures such that you're at the end of the line if you trade on the OTC market versus exchanges. Reform number 6, reduce conflict of interest in the major credit rating agencies by restricting the rating agencies to their rating business and by dropping for now the formal link between credit ratings and risk weights. As you know, performance of the rating agencies in this crisis has been abysmal. It wasn't just due to inappropriate methodology. There's a lot of indication that conflict of interest was also involved. You had the consulting arms of these agencies helping firms design these complex structured products like CDOs, and then you had the ratings arm giving the rating on them, validating the consulting. My recommendation is similar to what was done in the auditing accounting profession after Enron. Split the business off. The rating business is important for investors. You want to do consulting, you do it in a separate firm, no firewalls. Until we see a sustained improvement in performance, I would suspend using the ratings. 7, improve incentives in the originate and distribute model. You've all heard about this. You know what the charges are. Basically is that when mortgage originators sell their mortgages on down the distribution chain, your argument is, well, they don't have enough skin in the game. Another charge is that that model didn't deliver what it advertised, which is more financial stability, because it didn't, in fact, transfer risk to those who were best able to bear it. In some cases, didn't transfer it at all. A lot of this stuff was held in off-balance sheet vehicles, which had maturity mismatches. So once you got rising delinquencies for the underlying securities, they couldn't fund themselves, and then you had big losses. And in cases where they were sponsored by banks and investment banks, either they had to be taken back on balance sheet or they had to be bailed out. In some cases, they were allowed to fail. I think these charges against the originate and distribute model have some validity. The question is what to do about it. I don't have very many doubts that if you pay mortgage originators for how many mortgages they push out the door, and if you pay them an extra bonus if they put you into a high interest one that you can't afford, well, they're not going to spend a lot of time doing credit assessment. Hence, where you have that, you need to change the form of the contract. A recent paper, however, has shown that it's not completely true, that they have to, the packagers, the originators have to warehouse this stuff before they put it together. They retain the mortgage servicing rights, and so they do have losses. And of course, we've had big losses in among some of these things. Another way to get more skin in the game is to push the covered bonds idea, which is so big in Europe and which has been a favorite of the Paulson Treasury. The basic idea here is instead of backing up a securitized instrument just with the payment flows from the underlying instrument, the issuer of the security also guarantees it. So he steps in with payments in case those aren't made. And you get very few defaults. The problem is it's hard to get those to take off in the U.S. market when you can get cheap loans from the Federal Home Loan Bank boards and when you got Fannie and Freddie to do the insuring. Another way to go is to improve disclosure and documentation for these projects and only to sell them to sophisticated investors. That's the approach taken by the Counterparty Risk Group. When I buy 100 shares of Citigroup from my broker, I don't ask him to hold 10 of them, right? He doesn't have to buy 10 for my 100 because I know what I'm buying and I know that I take the risk. But if they're very complicated, the disclosure isn't very good, different story. On the distribution side, what you'd like to happen is when these things get put in off-balance sheet things, you'd like it to show up in one of the capital ratios, either the risk-based one or in the leverage ratio. So that's where I think you go on that. I don't think you want to try and push the clock back on securitization, but you want to improve the incentives. Eighth reform, need to do something about Wall Street compensation. Not how much you get paid, but how you get paid. What's wrong with it? Well, I think the best explanation is given by Raghu Rajan, former counsel of the fund, and he says, look, this is what's going on. You don't get paid for getting the market rate of return, for beta risk. You get paid for beating the market return regularly. So you get rewarded for alpha risk. The problem is the manager has an incentive to take on false alpha if he can get paid for it. In other words, he will appear to generate excess returns, but he will really be taking on hidden tail risk. The AAA rated tranches of CDOs are an example. You got 50 or 60 basis points more than you got if you bought a AAA corporate bond, but what you were being compensated for was the low probability that these mortgages would go bad and you'd suffer a big negative loss. The rub, as Rajan explains it, is that true alpha can be measured only in the long run and with the benefit of hindsight. So if you pay managers annual bonuses and you don't claw back any, well, then you create incentives for people to create false alpha. And the antidote for that is to have deferred compensation plans so that you only get part of the bonus up front and the rest when you confirm your superior performance over a longer time period. Reform of Wall Street compensation has been discussed for a long time. The catch has always been that firms are reluctant to do it because they lose valued employees to firms across the street that don't do it. So you got to give them an offset. And the offset you should give them is a capital charge. If you have a sensible deferred compensation plan, you do that. Reform number 9, rationalize the U.S. financial regulatory structure along the lines of the U.S. Treasury blueprint. I'll spend very little time on this. Why do we need 5 banking supervisors in the U.S.? One will do. Whether it's the FDIC, or the Fed or whatever, I don't see that we get any advantages. One place where I think the Treasury blueprint had it wrong is they suggested investment banks should be put under the business conduct and consumer protection regulator rather than the prudential regulator. I don't see how you could say that after Bear Stearns and Lehman and others. As I suggested earlier, we have the OTC derivatives markets, and the AIG case suggests that the CDS market has not been subject to sufficiently rigorous oversight. So we need to do more on that. Somebody's got to be watching that. The Office of Thrift Supervision, for some strange reason, was the principal supervisor for AIG, its derivative activities, because they owned apparently some small S&L someplace. But this is not cutting it. Finally, last one, got to reform housing finance. How to do that? Bunch of things. First, put more resources into education about mortgage financing, even before people become mortgage applicants. Buying a home is the biggest purchase anyone usually makes. Have a short course for seniors in high school explaining what a sensible mortgage is. You can have neighborhood stuff. Apparently, this makes some difference. If people understand what it is, they have lower delinquency. Should be a simple template for home mortgages along the lines laid out in the book by Martin Bailey and others. There should be a single federal regulator for the home mortgage industry that sets standards for mortgage originators and mortgage projects. Treasury should go the full Monty and put Fannie and Freddie into receivership on the way to breaking them up into smaller units and privatizing them. The financial industry should consider continuous workout mortgages. They're sort of like GDP index bonds for sovereign debt. Same idea. If the borrower's a condition changes very much, you can change the payment terms. And finally, we ought to put additional public funds into trying to reduce foreclosures. That's my 10. Just two caveats about it. I'm not saying that regulatory failure was the only cause of the crisis. There are a lot of other things, but it was, in my view, a major regulatory failure. Two, regulatory reform doesn't come for free. If you're going to impose tougher capital and liquidity requirements, cut way back on OTC derivatives, the financial industry is going to have lower leverage, slower asset growth, and probably a lower average profit rate than they've come to expect. Of course, the other side of that coin is that you and I are not going to pay as much for these crises. So I'm in favor of it. All right, enough for the longer term. Quickly on what's going on now. Macroeconomic stimulus. If the U.S. economy continues to weaken significantly during this and the final quarter of 2008, I would favor a response. Lower Fed funds rate, a second fiscal stimulus package. The IMF and the G7 may have a role to play there. What about the TARP? I was in favor of doing something. I hope it works, but it doesn't seem to me that it's designed right. I think we should amend it so that most of the money is used for bank recapitalization and home foreclosure mitigation rather than purchases of troubled assets. Why so? Well, Treasury can use, let's say they use a fifth of the $700 billion or so for auctions. That ought to be enough to establish greater transparency about the fair market value. They can use this to get a better fix on the financial balance sheets of financial institutions. If you want to help banks buy what you buy, there are better ways to do it through bank recapitalization. And you want to give everybody lots of money who wants to sell an asset because some of them are not going to be viable. After the auctions are completed, you should direct supervisors to do a fresh evaluation of the solvency and capital adequacy of all systemically important institutions. Those who are moderately undercapitalized and want to participate, you should tell them, well, look, this is what you need to do. Here's what your capital needs to be. You do half of it. Suspend, reduce dividends, and go out and raise capital in the market. If you do that, we'll give you a capital injection for the other half. And we'll take warrants as well. And you'll agree that you're going to expand your lending. So we know we get a flow of credit to the economy. Given the importance of bank recapitalization to reestablishing trust, I would put $300 billion of the TARP into bank recapitalization. I put the other $300 billion into foreclosure relief. It's not clear whether you can do this in the TARP. I read the bill. Some say you can. We'll see if you can. Good. On liquidity, I think central banks will continue to be active and innovative. That said, I'm concerned that it will be difficult to restore trust in interbank markets unless there is significant bank recapitalization effort. I think these private sector liquidity pools will also be useful. All right, in closing, we will, of course, get out of this crisis. So long as the U.S. government remains creditworthy, there are lots of bullets left. There can be a series of coordinated interest rate cuts. The Fed can extend further the scope of its liquidity assistance to more types of financial companies, even to non-financial companies. It could do unsecured lending. There can be fiscal stimulus bills 2, 3, and 4. There can be TARPs 2, 3, and 4. There can be further consolidation in the financial sector. There can be further and wider guarantees of bank liabilities. There can be bank recapitalization programs. There can be larger public money spent on foreclosure relief. There can be more regulatory forbearance. But in the end, 3 questions are paramount. How much will the real economy decline before the crisis is done? Second, what will be the effect on net U.S. public debt after all the government bailouts and guarantees? And how will that affect crisis management in the future? And last, how will the government's rescue operations affect the incentives of market participants to take risk after the crisis is over? Let me stop there.